Welcome back. What we'd like to do is take a look back at the month of August and highlight the most significant economic reports we've seen as we try to gauge the Federal Reserve and the likelihood of their next interest rate decision and also how that may affect markets moving forward as well. And these are only some of the most significant economic reports. Certainly, it's not all of them. About a month ago, we did see non-farm payrolls that were reported rose 187,000. That was below market expectations of 200,000. The unemployment rate at the time from 3 point fell to 3.5 from 3.6%. We can see here in the non-farm payrolls. This is some of the lowest levels we've seen over the past couple years, and certainly does not bode well for the overall economy and moves the Federal Reserve a little bit further away from the idea about raising interest rates. Here's the unemployment rate, which did stay steady versus a blue line, that's the S&P 500. Typically, when the unemployment rate goes up, we see weak stocks, and conversely, when the stock market goes up, we see a low unemployment rate. We'd like to see the unemployment rate fall if we continue to see strong stock markets. That would logically make sense. The consumer price index, which is a very popular gauge of inflation on a month over month basis, was unchanged at 0.2%. Core CPI, which excludes food and energy, was also unchanged. Year over year, CPI rose to 3.2 versus a prior 3.0%. Core CPI 4.7 versus a prior 4.8. Core CPI excludes food and energy, which are the more volatile components, but the overall consumer price index is rising. The Federal Reserve has a 2% target, and we know that if the Federal Reserve does not see 2% on inflation, it will continue to raise rates over time. Here's CPI year over year. All of these are year over year in purple. The red line shows core CPI. The orange line shows the food. And then, of course, the energy, which is the most volatile component of this index, is on a year over year basis, was quite strong, has moved to the downside. Recently, we've seen a tick higher in energy prices. All of these numbers put together indicate a level well over the 2% level. Here's PPI, Producer Price Index, on a month over month basis, zero point 0.8 versus expectations of 0. Or I should say, actually, the prior report of zero point 0.2. The core PPI was unchanged. The difference is PPI, Producer Price Index, measures a basket of goods and services on the producer wholesale level, and it is thought that if the producer price index rises, they'll pass on those extra costs to the consumer. We can see here the PPI, that's the yellow line, is below the red line. Now that excludes food and energy. So we can see excluding food and energy, the core PPI is higher. That shows us that food and energy are actually dragging the wholesale lines down. It shows us that energy and food has declined, but other measures of inflation on the producer, which is the wholesale level, and also the consumer level, are still quite high. Here's core CPI year over year in white, core PPI in green, uh, PPI in yellow, and CPI in red. Now, in particular, notice the highest line we see here is the core CPI, excluding food and energy. And this is actually quite troubling because what this represents, this white line, is a basket of goods and services that we pay for, not taking into consideration food and energy, which is really everything else. We can understand if gasoline is expensive. We can understand if food prices are going up. But if everything else is also going up, the cost of shoes and washing machines and everything in between, that I think is more troubling. We can understand to an extent from an economic point of view rising fuel prices, rising food prices. They're more volatile, but the other prices we expect to remain more steady. Retail sales up 0.7% versus a prior 0.3 on a month over month basis. 3.2 versus the prior 1.6 year over year. This is encouraging. This is one of the better spots in our month. Retail sales we can see year over year in red, S&P 500 in blue. We did see that very big spike up at the end of 2020, early 21. I think that was a result of low interest rates and also a lot of spending programs that were put forth following the COVID crisis, which really tried to get everybody, back to the stores. But that has declined. I know it's a tick to the upside, but we can see clearly from the chart, the red line, the retail sales line, is actually quite low, relatively speaking. We haven't seen these levels going back to actually early 2020. Here we can see the retail sales broken down sector by sector within this index. For example, non-store retailers, I like to think of online shopping in this category, that's up 10.3%. This is on a year-over-year basis. Gasoline stations, that's down almost 21%. We know fuel prices have declined recently. Motor vehicle and parts also up 7.6% year over year. Retail trade, excluding motor vehicles and gasoline stations, is also quite strong at 5.3%. So it looks like retail and online retail seems to be the strongest components in a lackluster index, which is retail sales. Now we move on to manufacturing. Empire State Manufacturing, that represents the manufacturing industry within New York State. A level above zero indicates improving conditions. Below zero indicates worse conditions. This month, the index was reported to have declined 20.1 points to negative 19. It's the first negative reading since May, and that is not good. We can see Empire Manufacturing in yellow in the background over the S&P 500 in red. And we can see that since, I would say, January of last year, this manufacturing index has flirted with negative territory. And certainly that's not a good sign. And manufacturing certainly is a very important part of the economy and something the Federal Reserve also watches very closely. Now, here's manufacturing in Philadelphia. The Philadelphia Federal Index, also known as the Philly Fed Survey, it's a regional Federal Reserve Bank index and measures the business outlook within manufacturing in the Philly, I think it's a third district in the Philadelphia region. Philly Fed Manufacturing Index in positive territory for the first time since May of 22. And we can see here converse contradictory to the prior New York Empire index, which was pretty bad news. The general activity index is actually quite good. We can see a sharp move to the upside. I think that an expert, an analyst that specializes in manufacturing might be able to explain why Philadelphia manufacturing looks so much better than New York manufacturing. Maybe there's different industries or sub-industries. Nevertheless, this looks like it's positive, although it did have quite a bit to come back from. We were pretty deep territory in the negative region. We'd like to see this number continue higher. It looks like a nice positive correlation between that and the S&P 500 in blue. Here we see within the Philly Fed report, this is what seems to be working the best. The general activities up 12 points, new orders up 16, prices paid up 20.8 points, and prices received up 14. The negative side, inventories, employment, delivery time. But overall, this looks like a better than average report. On to housing. Existing home sales declined 2.2% to a seasonally adjusted 4.07 million. Sales declined 16.6%. That's year over year. The median existing home sales price rose 1.9%, and it was the fourth time the monthly median sales price exceeded 400,000. That goes back several years, by the way. So sales prices are up, but the actual sales are down year over year. This is new home sales. The monthly supply of new homes year over year down 28%. New one family homes sold year over year up 31%. So the monthly supply is down. New one family homes sold is up. New one family homes for sale down 5%. What does this tell us? The high interest rates are locking in potential sellers. They don't want to sell because if they sell, they may have to get into a new, very high interest mortgage. So the inventory is really suffering. It's something that the home builders are complaining about is a lack of inventory out there. Here's monthly supply of new houses. This is the ratio of new houses for sale versus sold. So when the number of homes for sale goes up, then we see the black line go up. Now it's going down. So it's new houses for sale is going down versus the homes that were sold. It seems that a lot of the homes that were for sale were sold, and there's not that many new homes out there. The housing market's really suffering from lack of inventory, and I think home builders are very tentative to get involved in any new contracts, any new building contracts, because there's so much risk out there. Here's new one family houses sold. This is in thousands in black, and the S&P 500 in red. Pretty nice, strong correlation. We can see as the S&P 500 goes up, that also tracks with inflation as well. Inflation moves in the same direction as the stock market. We tend to see those homes also are sold in the same direction on the chart. Here's new one family homes for sale in thousands, and that is in black. That seems to be tracking more or less with the S&P 500. When we see strong markets on one, we tend to see strong markets on the other. But again, it's called the lock-in effect. It's a really unusual phenomenon where we have a period of very low interest rates that are followed by a period of very high interest rates. And that locks in potential sellers to say, I have a 1% mortgage. I don't want to sell because then I'm going to have to get involved in a new, very high mortgage. Durable goods. The Commerce Department said durable goods fell by 5.2% in July. Durable good orders increased 0.5%, excluding transportation. So, durable goods, which are goods that are produced meant to last more than 5 years, aircraft, automobiles, washing machines, computers, things that are meant to last a long time, they fell. However, if you take out transportation, specifically Boeing, which seems to be a very large component of the transportation sector of durable goods, those actually increased, which tells us transportation is really falling. Durable goods up 3.8%, excluding transportation, only up 1.1%. Durable goods, excluding defense, up 4.1%. So it seems like transportation and defense is on the decline. Well, the blue line here represents, and this is all year over year, manufacturing new orders. We can see this is one of the lowest levels that we've seen in quite a while. This little blue histogram bar over here seems to be lower than almost all the other reports going back a couple of years now. The red line is consumer goods. That seems to be probably the best part of durable goods, new orders on that respect. Excluding transportation, that's very, very low. Excluding defense, that's in yellow. That seems to be lower as well. S&P CoreLogic Case-Shiller Home Price Index, the 20 city house price index, which represents the 20 large metropolitan areas in the U.S., rose 0.9% month over month, but year over year down 1.2%. Prices were up for a fourth month in a row, but that's on a year over year base, in a month over month basis. So June, July, or May, June, July, August. That is the 4 months that we see. The national index rose 0.7% month over month, unchanged year over year. All transactions home price index unchanged month over month. Nationally, 1.2% year over year. And we can see our the top center chart, the home price index, that's at 308. That continues to rise on a month over month basis, which is encouraging. Left hand side, 20 city home price index on a month over month basis, that is rising as well. All transactions index, that's flat, but these are month over month levels. And we've mentioned this in the past. I think it's more accurate to measure these home price changes on a year over year basis because there's such a seasonality in the housing market. The housing market is much different in August than it is in February, for example. Well, a couple days ago, the US GDP revision was released, and it was reported to have grown at a slower than expected pace in the second quarter at a rate of 2.1% versus the forecast of 2.4%. This is one of the big numbers the Federal Reserve watches. We don't want to see this number go down. This is probably the broadest measure of the strength of the economy. And 2.1%, that's really at the lower end of what we'd like to see. We can see here the prior number 2.0, currently 2.1. We want to see higher numbers. We want to see in the threes to be sure. And of course, we had that that very brief recessionary blip going back to late 21, early 22. but certainly we want to see GDP rise. A weak GDP number does take the Federal Reserve's opinion a little bit more towards the direction of not raising interest rates because this is so significant. Well, on the other side, the PCE, personal consumption expenditure, which is a rate of inflation, rose 3.3% versus the prior 3.0. This was inflationary. Core PCE, excluding food and energy, rose 4.2 versus 4.1. These are year over year numbers, and this PCE is very similar to the CPI in the sense that it measures a basket of goods and services at the consumer level. There are certain nuances in the way these numbers, I think the PCE is a much more broad based measure. Nevertheless, just as the GDP showed us that the Federal Reserve should back away from raising interest rates, the PCE, and if you remember the CPI and PPI, the inflationary numbers this month all marked gains, and those gains pushed the Federal Reserve more towards raising interest rates. Here's PCE in blue, core PCE in red. The PCE, which includes food and energy, is lower. Excluding food and energy is higher. So if you take out food and energy, we actually have even more inflation. And this 2% level, that's a Federal Reserve target. That's where the Federal Reserve wants inflation to be if it's going to stop raising rates. We're, we're well above that, and this report measures another tick to the upside, which is essentially moving in the wrong direction. Now, of course, at the end of the month, we wrap up. It's actually the beginning of September. Non-farm payrolls rose 187. We started off talking about the non-farm payrolls reported for the month of July in the beginning of August. Now, this is the end of August. This is actually the August non-farm payrolls, rising 187,000 July, above market expectations of 170. That's good. But if you recall, the last month, well, it was revised down. In fact, June and July were both revised down by a total of 110,000 jobs to 105 and 157, respectively. So, any good news we saw in last month's job report, they took it away. The unemployment rate rose to 3.8% from 3.5. Average hourly earnings remained at 4.3. That's less than the expected and prior 4.4. The labor force participation rate rose to 62.8 versus 62.6. That's not that bad. But the non-farm payroll we see over here did rise. But if you see the last two numbers prior to this, June and July, they were revised down. And if you take in consideration the big picture, going back to mid 2021, these are not good non-farm payroll numbers. We should see, especially considering the strong stock market we've seen lately, we should see higher non-farm payrolls. Here's the unemployment rate, again, picking up to 3.8%. This is the first time we've seen 3.8% in quite a long time, actually. Typically, again, we see high unemployment rate, low stocks, low unemployment rate, high stocks. Well, if the stock market is testing recent swing highs, why is the unemployment rate also testing recent swing highs? One of them doesn't make sense. Average hourly earnings, that also seems to be declining on a year over year basis. We'd like to see, making more money. That would certainly support a stronger stock market. We don't see that connection here. Putting the entire month together, we now stand at the federal funds futures a 93% chance that the Fed will keep rates unchanged at the 525 to 550 level in their next meeting in September, and gives the Federal Reserve only a 7% chance to raise interest rates to the 550, 575. And we know over the past month, we've seen a ton of economic news. We had Federal Reserve minutes that were released. Richmond Fed presidents, Fed President Bauman, Bostic just the other day from Atlanta. Also, we had the Jackson Hole, Wyoming Fed Summit where Chairman Powell said, we're sticking to our 2% target. We're not wavering from that. And, we're concerned about inflation. Of course, the Atlanta Fed President Bostic yesterday said that he believes that the housing market may be cooler than expected, but he also expects the Federal Reserve to continue to raise interest rates. But putting all these significant numbers together and much, much more, We see it's very likely the Federal Reserve will not raise interest rates in September, but there is still a very good chance that they will continue or resume interest rate hikes as long as inflation stays this high, as long as the jobs market does not get really, really bad. It's weak now. As long as GDP does not get very, very bad, but it is also weak now. Retail sales don't look good. The housing market's tricky. So we're going through a very tricky situation over here, torn between inflation that just doesn't want to quit, yet underlying economic forces within our country that don't look so good, meaning the jobs market, the overall GDP, the other components we use to gauge the economy. So we're going to, like the Fed, watch these economic numbers very closely, and we'll hopefully get a very good gauge on what's to come in the near term future. We hope this has been helpful. We look forward to seeing you back soon.